Stability Insight, where we get you a 360-degree view of the big picture driving business and the economy. I'm Kimberly Lim here in London, and this is what we've got coming up for you on the show. The financial turmoil in the Eurozone threatens to take a toll on the world economy. So how bad is the situation, and is there a solution in sight? And an exclusive interview on the crisis with Jan Randolph, head of sovereign risk, IHS Global Insight, on the future of the euro and the Eurozone. So our top story, the European economy is in turmoil as toxic sovereign debts threaten to bring down the banking system. Now, collective political will is required to solve this crisis, but that's no easy task as members of the union are grappling with serious domestic issues, including rising unemployment, shrinking growth and a liquidity crunch. So just how widespread is the crisis, and is there a way out? Nikhil Sivadas has more.
The land of gods is in need of divine intervention. And even though the government in Greece is not calling its economic crisis a default just yet, it's quite obvious that the situation is worse than expected.
Whoever uses the word default in relation to Greece, a Eurozone country, either doesn't understand the meaning of the word or is playing in the field that has been shaped by the uncontrolled and speculative segments of the international markets.
The solution, a second round of bailout. And it comes just a year after EU countries assisted Greece with 110 billion euros to get its fiscal house in order. A default is a big worry because it could have a domino effect on the banking system of several economies in the region which hold Greek debt. Besides, it will lead to severe market volatility and liquidity pressures on sovereign credit in the region and could even jeopardize the future of the euro. The EU members realize the catastrophic impact a default will have. However, this time Greece may not be able to get its friendly neighbors to commit assistance as easily.
There's an evident risk that the Greek program is off track. We haven't seen the Troika report, but the off-track risk is very high at this stage. So I think now we have to rethink how we can faster move forward towards backstops and firewalls to be able to handle a situation where the program is off track.
We need first of all we need to go to the implementation of the first package. We need to have a vote in some parliaments, in Netherlands, in the Slovak Republic. That's urgent. And second, we need to conclude with the private sector the first package. And then we will maybe speak about another one, but for the moment the most important thing is to implement. Not only in Greece, it's important to have a clear execution in Greece of all the measures taken, but also in Netherlands and Slovak Republic to go to the parliament and to vote the implementation of the first package.
Indeed it is, because now it's not just Greece that needs help. The past year has been turmoil-ridden for the Eurozone as a whole. Ireland sought and received a bailout from the EU. 6 months later, Portugal followed suit. Now two large Eurozone economies, Spain and Italy, are not looking robust. Sovereign ratings downgrades in recent months reveal more. Last week, rating agency Fitch downgraded Italy and Spain and put Belgium's ratings on review on account of high risks associated with the crisis. Prior to that, Moody's had downgraded Italy. In July, Moody's had put Spain's rating on review for possible downgrade because of increased vulnerability of the government's finances to market stress. S&P has rated Spain a AA with a negative outlook, and Fitch's ratings for Portugal remains on watch for a downgrade. The downgrades in sovereigns' ratings has taken a toll on the financial markets of all Eurozone economies. The only way out of this huge mess is to stand united.
In my personal view, Europe will need to make significant progress towards political unity with an executive branch and a parliament, both with extended responsibilities as in any democracy. Part of this executive branch would be a European finance ministry, which would be responsible not necessarily for a large federal budget, but certainly for a strong economic and fiscal surveillance and governance, for the handling of the financial sector, and for the external representation of the economic and monetary union.
Enter the European Financial Stability Facility, or the EFSF. The EFSF is a temporary facility for issuing bonds of up to 440 billion euros, guaranteed by member nations for lending to those members that are in difficulty. The EFSF is an overall rescue package of 750 billion euros, comprising 60 billion euros of funds raised by the European Commission as the European Financial Stability Mechanism, or the EFSM, and up to 250 billion euros from the International Monetary Fund, or IMF. After extending support to Portugal on 2 occasions and then to Ireland, member nations want the EFSF ratified before the second Greek bailout. Germany wants the private sector to take a more severe haircut, and Finland wants collaterals.
Countries that do receive collateral have the obligation to pay their capital into the future ESM in one tranche in the first year when the ESM is created, while the normal approach is that countries pay in their capital over a 5-year period. Second, the profits from the EFSF to the countries that receives collateral will be reduced for countries that receive collateral. Third point, in case of default, the collateral will only be paid out after at the time when the EFSF loans mature, which is 15 to 30 years. That means the collateral is frozen for a very long period. And finally, a country that requests collateral will get no more than 20% of the increase in its guarantee. Those are the compensations for receiving collateral. It is a price to be paid.
The EFSF has a tenure of 3 years that is up to June 2013. And a new program, the European Stability Mechanism, or ESM, will be set up as a permanent rescue funding operation to succeed it. While the mechanism to ensure that the economies don't sink is in place, there's nothing to ensure that the banks and financial institutions escape unharmed. A stress test analysis conducted in July by the European Banking Authority, or EBA, revealed that the Belgian-French bank Dexia was financially strong with a core Tier 1 capital ratio of 10.3%, well above the 6% threshold limit. But it needed to be bailed out earlier this week, primarily on account of higher than expected haircuts needed due to exposure to Greek debt. Dexia is saved, but the question that everyone's asking is Dexia Europe's Lehman Brothers?
We're having a crisis in the financial situation right now, in the financial sector, I should say, simply because there is a problem in the sovereign sector. Many of the banks that you have are holding, for example, quite toxic sovereign debt, directly or indirectly, for example, through other banks in the Eurozone which have direct exposure to bad sovereign debt. So I think the two are interrelated, and until the sovereign issue actually gets resolved, the financial situation won't get resolved anytime soon.
So just how vulnerable is the Eurozone's financial system? That depends on its exposure to debt in what is now commonly referred to as the PIGS economy, which includes Portugal, Italy, Ireland, Greece and Spain. Let's start with Greece. According to the Bank for International Settlements, in the last quarter of last year, Germany was the largest holder of Greek public sector debt, followed by France, UK and Italy. And France was the largest holder of Greek non-bank private debt. The UK has the highest exposure to public debt and non-bank private sector debt in Ireland, while Germany has the highest exposure to Irish banks. Spain had the largest exposure to Portugal's public sector and non-bank private debt, and Germany had the highest exposure to its banking sector. Germany also had the highest exposure to the banking sector in Spain, followed by France. These two countries jointly had a significant exposure to the non-bank and public sector debt of the country. According to an IMF report released in September, sovereign risks have spilled over into the banking system, and these spillovers have increased as the crisis spreads from Greece to Ireland and Portugal, and then to Spain, Italy and Belgium. It's estimated that troubled banks in the Eurozone will need at least $266 billion for recapitalization, although that could be an underestimation as well. IMF analysis shows that nearly half of the 6.5 trillion euro stock of government debt issued by euro area governments is showing signs of heightened credit risk, as opposed to just 5% represented by Greece in April 2010. As a result, banks that have substantial amounts of more risky and volatile sovereign debt have faced considerable strains. Since January 2010, the market capitalization of EU banks has declined by more than 40%, but the worst may not be over.
We're already seeing basically stress in money market rates increasing in Europe, and we're seeing that basically funding for companies through capital markets is starting to become a lot more challenging. That is the reason why we believe that European policymakers need to come to the table sooner rather than later to contain basically the fiscal risks from peripheral Europe and thus bring down these concerns regarding funding and liquidity in Europe.
It's important to save Greece and other European economies that might default because they will have a cascading effect on several large economies in the region. An analysis by Reuters states that if France defaults, there are 50% chances of Spain and Italy defaulting too. Similarly, if Italy and Spain defaults, the chances of Ireland and Portugal defaulting are high. This domino effect is what should worry the world.
The most vulnerable part is now Italy. So because it's very big and will have a much more significant impact on other economies than Greece. So that's why people worried.
We would want to see haircuts for a number of the weak sovereign nations, making their debt sustainable going forwards. At the same time, obviously, a big bank recapitalisation, I think, is needed for many of the Eurozone banks, and that could be to the tune of 200 to 300 billion euros. Additionally, I think we would want to see a ring fencing of Spain and Italy. They are funding at too high levels, and this is where a proposal for common bond or even bill issuance to really get the funding of these two very important Eurozone nations much lower to again enable them to have a sustainable path of debt financing going forwards.
At this point, the remainder of this year and at least the first half of next year are going to be very problematical economically. We will see very little growth, if any, in the United States and in Europe. And from that standpoint, since a lot of these emerging market economies are, of course, basing their own growth on exports to Europe and the United States, it's difficult to see, which way we're going there.
That's perhaps what made the US President Barack Obama and British Prime Minister David Cameron urge the Eurozone to find a solution to the Greek problem at the earliest.
Need of reform.
Two of the largest European nations, Germany and France, have stated that they have reached an agreement to recapitalize the region's weak banking sector. However, the details of the agreement are expected to be released before the crucial G20 meeting to be held in France in the first week of November.
Now, while European giants have been making all the right noises about their willingness to steer the region out of the crisis, there are still fundamental questions that remain unanswered, like what will happen to the euro? Will the Eurozone break up? And most importantly, where will the money come from to recapitalise the banks? All that and more after the break.